When someone says things like personal finance lessons that transform my life, you listen. Now, I have not seen these or heard these, so we'll see how good they are. Transformation of life generally means a transformation of habits. So, as you watch this, I want you to think about the habits you have. And as you have a goal of seeking some financial freedom and working towards bettering yourself, that means sacrificing some of the things that are part of your daily routine now. So you just have to change your mindset and realize that in order to obtain these things that you want, obtain these goals you want, work for the dreams that you want, that what's you're comfortable with right now is going to have to change. So that's going to mean not doing the same thing. Sometimes it means not hanging out with the same people. Sometimes it means totally different change of lifestyle. Sometimes you take several steps back in order to jump forward. So don't be afraid to make those changes. Don't be afraid to take a step back. Don't be afraid to distance yourself from people that don't share the same focus, don't share the same mindset in order to obtain the goals that you really want to set for yourself.
Hey guys, welcome back to the channel. In this video, I'm going over 10 key lessons in personal finance that have transformed my life, and I think that they will transform yours as well, as long as you put them into place. So let's waste no time here and get...
As long as you put them into place. Anything that there is going to change your life, you have to do it. It's going to be actionary. So take notes. Let's see what these are, but make sure you know that if you really want to make these changes in your life, you're going to have to start putting them into action.
And into personal finance lesson number 1, which is that delayed gratification is crucial to everything. If you can resist the temptation of an immediate reward, then usually your payoff will be a lot greater later on in life. This happens often in the investing world. So let's say you invest in the stock market. If you buy and hold for a very long time, let's say 10, 30, or even 50 years, the bigger and bigger your gains are going to be. It's the same reason why so many financial experts recommend not touching your savings or your 401k, because they know that if you have your money in one of those accounts, the longer that it has to compound, it usually is better for your retirement.
If you learn how to compound your money, you're going to be night and day better than anybody in the same room as you. The important thing you're going to have to realize with this number 1, which I'm sure he's not done with it yet, is marketing today is set aside specifically to target you and trigger your emotions so that you don't want delayed gratification. You want everything right now, which is why you get into debt, which is why credit is such a big deal, which is why you throw things on to your credit cards, or you're like, you know what, I'm going to get paid in 2 weeks. Rent's due in 10 days. I can be 5 days late. I'll get this now and worry about the bills that when they're due later. And as you're constantly robbing Peter to pay Paul, that's when things do start to pile up and you get yourself in trouble. So this first one is something that everyone should do, and your parents really should be teaching you that at a very young age. So if you are a parent, start teaching your kids this now. They will be successful adults because of it.
In terms of everyday purchases, delayed gratification can be boiled down to a simple phrase, which is that if you can't buy it twice, don't buy it. So hopefully that phrase is pretty self-explanatory, but if you can buy an item twice, then that probably means you're in a pretty good financial position in order to buy that said item. For example, let's pretend you want to buy something worth $500, so maybe a new Xbox or PS5. And you can afford it once, but the idea of a purchase that's over $1,000 seems kind of daunting. That's when I'd probably argue you can't afford the $500 purchase in the first place, because if the $1,000 purchase makes you uncomfortable, then it's probably not a good idea. Delayed.
Very true. So if you're scraping money together in order to buy something, you should not buy it. You need to, anything that you're buying that means that much to you, you need to make sure you take a deep breath and reevaluate before you buy it. Now, when I'm doing consultations with people, I'll make this scenario in which I ask them if they can afford $5 a day. $5 a day. Yeah, I could probably come up with $5 a day. And then about a third of the way to halfway through the conversation, I change it to, what about $150 a month? Let's just stick with the $150 amount we were talking about earlier. Whoa, whoa, whoa. I never said anything about $150 a month. $5 a day times 30 days in a month is exactly $150 a month. All we're doing is different math. So if we bring it down to a small dollar amount, all of a sudden it's not that big of a deal because it's only $5 a day. I can not get an energy drink and give that up, and all of a sudden I've got that. And then you're like, wait a minute, I've been spending $150 a month on energy drinks. So you've got to really understand both what you're spending each day and what you're spending each month, and that's just marketing. So if you can't double it, whatever it is, the Xbox is a great example. If you can't not miss $1,000, then that $500 expenditure is not something you should be doing. So far, he's on to something. I really like what he's got going on.
Gratification can also help with your decision making. I find that whenever you have a decision presented to you, and especially if it's a big decision in your life, such as a career change, if you zoom out 10 or 20 years, usually the picture becomes a lot clearer. So I personally remember a situation at work that I was in. So I was working in the monetization department at a mobile video game company, and I wanted to switch to marketing because they had a higher base salary for their employees. The short-term thinking in me wanted the extra salary of 10 or 20K by switching over to marketing and doing roughly the same amount of hours of work. But the idea was like, okay, if I zoom out 10 or 20 years, I didn't really want to be doing marketing in 20 years. So it really didn't make any sense for me. So if you can combine long-term thinking and delayed gratification, that's when I think you become unstoppable in life. Personal finance lesson number 2 is to track 3 numbers. I like to call them the big 3. And those 3 numbers are your expenses, your savings rate, as well as your net worth. I find that if you're able to track these 3 numbers and make improvements to them over time, your personal financial position will just get better and better. And there's no doubt in my mind that you will become financially free. When it comes to your expenses, the first thing you want to track are your fixed expenses. So things like your transportation, your housing, your utilities and healthcare insurance, etc. And you want to make sure that as a percentage of your income, it's not making up more than 50 to 60%. If they are
Probably 60%, especially in today's day and age, if you're including the transportation and housing and utilities and healthcare all into one big thing. We'll see what the discretionary expenses are, but I just call this budgeting. And a lot of times people hear the word budget and they're automatically like, they just tighten up and they get rigid and they're like, I don't want to live under a budget. But when you realize that living under a budget is actually freeing because you know where your money's going, you know how to spend, like everything is done with a plan and with intent. And a quote that's thrown around all the time is if you fail to plan, you plan to fail. But how many of us are living life with no plan? We know what our goals are, we know what we want, but we have no idea how we're going to get there, and we're not doing anything we at all to get on the right path to reach said goal. And it starts with something as simple as knowing your budget and living within your means and saving up for things instead of buying and having something there in case of emergency. Let's see what his discretionary expenses are
larger than 60% of your income, that's when things get a little bit dicey and you might not have enough money in your other parts of your budget for things like discretionary expenses or even savings and investments. When it comes to discretionary expenses, I like to keep my personal expenses in check. So I do that by tracking everything that I spend, and then I just have frequent check-ins throughout the month. Let's say your target spend per month is $1,500 in discretionary expenses. Then what you can do is just have a check-in, let's say on the 15th of the month, so halfway through the month. Your discretionary expenses should be around $750. Now, if you
So what's nice about this is he's not like telling you put the handcuffs on and you're not going to be able to spend your money. He's telling you just do what you normally do, but check up on yourself, have some accountability for yourself, and make sure that if it's 1,500 and 2 weeks in you're at 1,000, you know you need to reel things back in, and you're getting way too close to that. Make it a game. It's funny how if you gamify life, that you tend to succeed and win because it's more fun that way.
are ahead of that, so let's say you've spent $800 or maybe even $900 by the 15th day, you know that you need to cut back a little bit for the rest of the month. When it comes to tracking your personal savings rate percentage, I would try to aim for a percentage of savings of your income of around 10% and then slowly try to ramp it up from there. Ideally, if you're tracking your savings rate, you have more of an eye on it at all times. You're more aware of it, and
I know inflation, all the different things in life that's happened in the last several years. A lot of people are living paycheck to paycheck, or they're living just comfortably, but there's no investments, there's no retirement, and there's no savings. It's essential to make sure you have that. What happens if your transmission goes out? What happens if a fire breaks out in your kitchen and you've got to come up with a deductible? Insurance covers everything, but you still got to pay your deductible. What happens if you get sick because it's super cold outside and you can't work for 4 days and now your paycheck's half of what you thought it was going to be or your budget allows? Like, you've got to make sure that you are setting yourself up for success and not for failure. And the only way to do that is give yourself a cushion.
Now, hopefully it's going up over time because as your savings rate increases, that means you're going to have more money for activities such as investing.
Look at all this more space. So many aerobics in here. So many activities. Do step class. It's making my head spin how many activities we can do.
Now, speaking of net worth, this is the last number that I like to track, and the whole idea of tracking it is mostly for peace of mind. I think it's a wonderful thing to track because it'll give you perspective on your financial life, and so sometimes I'll even look back to my expense tracker from, say, 2021 or 2020 and just see how much my net worth has grown over the years. If you'd like a link to my own
I'm glad that he throws links in there. That's cool because tracking one's net worth is not something that most people do. One and two, it's not just a glance at a piece of paper. No, you've got to know what the formula is. You got to know what things are assets, what things are not. I mean, liabilities versus assets is a conversation that's for another day. But if you don't even know what the definition of those things are, how are you supposed to track them? And then we can get into what's good debt versus bad debt and revenue streams. Like there's all kinds of different things that really matter in building a net worth. But in order for that to happen, you've got to know how to track it. And again, set your goals, set your path, and then follow it.
net worth tracker. I actually made one a couple years ago and I made it completely free, so I will leave a link to that down below in the description. Personal finance lesson number 3 that transformed my life is that you don't actually have to invest in too many things. I see this situation a lot with some of my friends as well as my subscribers' investment portfolios is that oftentimes people invest in way too many ETFs and way too many stocks for their own good. And oftentimes people
Diversity is key, but not to the point where you don't do research. Like, especially he's talking about stocks and stuff. When you're trading stocks, especially crypto, if you're doing something that's volatile, you need to understand what your money's going in. And just because you're able to invest something, any type of investment needs to be with disposable income in which you're not like going to the casino and you have to win in order to pay rent. Like you have to have the mentality as if this totally goes away, my life is not going to change. Otherwise, you shouldn't be doing it. That to me is part of investments. Like there's no such thing as a risk-free investment. Even something that's super low risk is still like the word risk is in low risk, right? So just gauge your tolerance level and do it. But sitting on the sideline throwing money underneath the mattress in your bedroom is gaining zero interest. It's not growing at all for you. So this is all better than nothing. But diversification is different types of investments, not all in the same thing with different stocks.
think that they're doing a good job by investing in, let's say, 10 or 12 ETFs, but the thing is that usually they have overlapping holdings with one another. Like, for example, if you took ticker symbol VOO, which is Vanguard's S&P 500 ETF, and then you also bought VOE, which is Vanguard's mid-cap value ETF, you can see that 92.1% of VOE's holdings are in VOO already. So while you think you could be diversifying your portfolio by investing in a bunch of ETFs, you could actually be doing the opposite and probably doing more harm than good. Most index tracking ETFs are super simple and very well diversified, so oftentimes you just need 1, 2, or maybe even maximum of 3. And if you are having way more than that, you might just be making it more confusing for yourself. Investing should be simple and passive, and most casual investors that just buy an S&P 500 ETF, for example, over the past 15 years, they would have outperformed 92% of large active fund managers according to S&P Global. All right, personal finance lesson number 4 today is to be aware of big purchases that are depreciating assets. We all know things like cars depreciate, but other things depreciate as well, such as jewelry and watches, clothing, books, smartphones, and even computers. So if you're spending money on one of these assets that are depreciating, the worst thing that you can do is actually borrow money to finance it, because at that point you are borrowing money from, let's say, a bank at a high interest rate, and you are not only paying the bank to finance your purchase, but you are financing something that is going down in value over time. You are paying money to lose money in this case. Now, I'm usually referring to things like jewelry, clothing, or even furniture. I mean, when was the last time you bought, let's say, a new couch? It was $2,000, but then only 3 years later, you throw it up on Facebook Marketplace. It's selling for $200. You just lost $1,800 on your purchase, plus the fact they might not even actually come to pick it up. Have you ever talked to somebody on Facebook Marketplace? They literally say they're coming, then they ghost you. It's a whole emotional roller coaster. All right, enough with
That is the truth. Understanding depreciation, like everyone knows that when you buy a car and you drive it away, that it's automatically worth less than when you paid it, right? But A lot of people don't think of jewelry. They think of jewelry as an asset that needs to be insured, which it does need to be insured. But that it's something that's going to go up in value, and that's where you don't understand supply and demand. Like no matter what you own is only worth as much as somebody's willing to give you for it. And so if you've got things that you've bought and you're making payment, like let's say you buy a car and your payment's $500 a month, if the value is losing $400 a month and you're paying out 500, it's actually dropping in value faster each month that goes by, and you're literally could be investing that money in other things. That's we can get deeper into other things, but into that at a later video. But understanding what's good to finance, what's good to pay cash for, when to sell things at its peak, when to buy things at its low, those are all things that are important to me, and it's something that I've really tried to pride myself in. But when it comes to individuals, even the very basic knowledge in understanding the depreciating assets is huge, and everyone should at least understand that.
Basic marketplace, let's get into personal finance lesson number 5, which is that if you invest for more than 20 years, it should typically yield positively. In the infamous blog post from the website of Dollars and Data, there's a really strong argument as to why the retail investor should stay invested over a long period of time. He points out that as stocks get more expensive, so he's using the PE ratio to gauge whether a stock is expensive or not, but essentially as the PE ratio goes up, their future returns generally decrease. And this kind of makes sense. Like if you buy an overvalued stock, it probably won't return as high as if you bought an undervalued stock. And you can see here that as PE ratios increase, so as stocks get more expensive, there's a negative correlation here with your returns for the next.
So like I get questions almost daily from people regarding their credit, and they're like, how fast can I get my score up? I need to go up 100 points. Well, it's really easy to get your score to go up 100 points if you're to 350. It's really hard to get your score to go up 100 points if you're to 700. Because the ceiling's 850, so you can only go up so far. And if you've got a 400 point gap, you can get 100 pretty quick. If you've got a 125 point gap, you can't. So it's the same thing when it comes to when you're buying and selling things. Like if at any given point the peak value of gold is $400 and you buy it at 200, you're 50% there. You've got some range. But if you buy it at 395 and there's only $5, is it really worth your time? That's why people really get like not necessarily turned off, but not as thrilled with Bitcoin anymore. Because yeah, you used to be able to buy it for a couple $100, and now it's worth thousands of dollars, right? Tens of thousands of dollars. But if you buy something that's a penny a piece and it goes to $1, you just 100 times your money, and it's still only $1. It. Those are the things that get people's blood going. But understanding how this works is what's key.
30 to 40 PE range than the 10 to 20 range, so red represents a negative return for the next 5 years. But the fascinating thing here is that as long as you hold for a longer period of time, you can see that as the years pass by, 5, 10, 15, 20, 25, etc., the number of red dots slowly decreases. The author states that, quote, over any 20-year period, US stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. So he's basically telling us that if we want to accumulate our wealth no matter what, we should just keep buying into the stock market. As long as our holding period can be longer than 20 years, it's unlikely that we're going to lose money.
Which goes right back into what I was talking about before. You have to be able to use income that you don't need to survive on. If you can truly take $1,000, put it into the stock market, and not need to cash it back out because you desperately need the money or you need it to double to pay your rent, like literally, if you put it there and you keep it there for 20 years, math says, history says you're going to be fine.
Oftentimes, people think that the stock market is overvalued and then they end up not investing into the market at all. The author used a really excellent example to drive this home in his blog post. So, for example, if you search stock market overvalued 2012 and you put that into Google, there are many articles that will come up detailing what investors believed at the time, which was that the market was overpriced by 50%. But if you look at this graph from the S&P in 2012, it was trading for around the 1400-ish levels. And if you had believed it was overpriced back then, you would have missed out on on some serious gains over the past 10 years. Personal finance lesson number 6 is that saving money is very important, yes, but at the beginning, it's the most important. Something that's not so obvious to people is that they think that making money has to do with how good their investments do or how good their business venture does. But when you don't have that much to your name, what you should actually be doing instead is relentlessly saving, so saving very aggressively. And the whole idea of this is that you want to
Which goes back to number one, instant gratification. You have to be able to save and be disciplined to have $1,000, $1,500, $2,000 just sitting there just in case for getting to the investment part so that you can really start to build wealth for your future. But if you want the latest Xbox, latest shoes, the newest computer, if you truly want to be buying these things, you're either dipping into your savings or you're taking away from the opportunity of your investments. So you've got to make sure that discipline and focus on your goals. The hardest thing I do when I'm helping people is stay focused on your long-term goals. We've got to have short-term goals that lead us towards the long-term goals so we can celebrate them along the way. Otherwise, you'll get burned out. But if all you're doing is living life, that's not, we were not put on this earth to just get by.
build up an initial nest egg so that it can compound for you later on, and then your money can make money on itself. So famously, the first 100K will probably be more comprised of savings rather than investment returns. So if we actually look at this calculator from the 4-Pillar Freedom blog, you can see that right here. If you save $13,000 a year for 6 years and you're able to attain a 7.5% return on your savings, you will have $101,000 after 6 years. But guess what? 77% of that 101K will be comprised of savings. In another case, let's say you have 10K per year that you're saving and you're averaging an even higher return, so 10% on your money. It will take you 7 years at a 10% return, but your savings still comprise 67% of your total $104,000 balance at the end. So with compound interest, we all know that friction is in the very beginning, so all the friction is at the beginning. So therefore, if you're able to save money when you have no money to your name, every dollar is going to be worth way more for you in the future because it's working for you as it's compounding. There really is no secret to getting over the hump, so getting your initial nest egg going. It really just takes a lot of discipline and savings and a lot of diligence. So if you are new to it, just stick with it. Personal finance lesson number 7 that transformed my life is that investing should be boring. You likely aren't going to get rich.
Yeah, that is true. And I don't know if I don't know what he's about to say, but for me, the biggest reason investing should be boring is because if it's not boring and you get your emotions into it, then you start making decisions that are emotionally charged and you're not going to be doing what's best for your portfolio.
By day trading, but what will get you wealthy over the long term is buying and holding into, let's say, an index fund and just simply forgetting about it. So I want to share with you guys a snippet from a podcast with the Psychology of Money author Morgan Housel, and it is really genius.
Your book taught me that successful investing is when you lose the password to your investment account.
Yes. Yeah, that's exactly it.
I don't actually think you said that in there, but that's like, when I lose the password to my investment account, I'm so proud of myself.
Yeah.
Because it means I haven't checked it in forever.
And I think this is really true. Like, we should be aiming to forget our investment account passwords so long as we are well diversified in our total investing portfolio. If you are invested for the 10, 20, or even 30-year time horizon and beyond, the best thing that you can do is just to hold and continue to dollar cost average into those investments. So that means continue contributing and investing. This strategy.
That's very true, and it goes along the same principles and guidelines that I really coach business owners to do. Is just because you make $100 doesn't mean that $100 is yours and it's profit. You've got overhead, you've got insurance, you've got all these things that happen. But then it's very easy for business owners to forget about the biggest bill that you have every time you make money, and that's your taxes. So not only do I recommend that you have a separate total bank for your taxes, but you don't have a debit card, you don't have any way you don't have checks. You can go once, you have to go in person, you got to go into the bank to withdraw once a year your money to pay your taxes, or once a quarter, depending on your business structure, to pay your taxes. And that's just protect yourself. But yeah, I mean, this all makes perfect sense. And so far, it's not something that anyone listening to this can't do themselves.
Strategy is boring and average, I get it, but listen in on this next quote from the same podcast on why you shouldn't try to beat the market and try to just aim for average returns.
I think it's extremely hard to beat the market, and very few people will do it. But I think there are really smart people who can do it, and people who I know who I could invest with. The reason I don't is not because I don't believe it can be done. It's because the variable that I want to maximize for in my investments is endurance. If I can just earn average returns for an above average period of time, it's going to lead to amount of success that will literally put you in the top 5% of investors.
So yeah, right there you have it. Top 5% of all investors just by being average and doing boring things such as investing in an index fund and just kind of stepping away.
One of the biggest things that is a struggle for everybody is FOMO. Just the fear of missing out is what's going to cause you to sell one stock and buy into another. And then when you think it's hit like you're never going to hit the buy at the bottom, you're never going to sell at the perfect top. It's just not going to happen. So you're always in your mind, like losing their password to the access that just let it ride out. You're going to be fine. Even when it tanks at the very bottom and you've lost everything, you don't lose until you sell. So hold, be strong and hold. And when it comes back up, you'll be fine.
Personal finance lesson number 8 today is to not pay attention to your peers, not in terms of life.
Hmm.
You definitely want to pay attention to them, but don't compare yourself to others. Personal finance is a life.
This is so far my favorite one because human nature is to compare yourself physically, spiritually, professionally, like nutrition, like every part of your life. You're like seeing someone go by, looking at them over here, like, but in reality, you don't know their walk. You don't know what they're going through. You don't know the struggles that they have, but on the surface, what they want you to see, everything's fine. But in reality, it's not. And so comparing yourself, especially in financial, especially in business, especially to your peers, is very dangerous. So I don't know why it's ranked 8. You should be bumping this one up. It's great advice.
Lifelong pursuit, and you might be tempted to draw comparisons to other people in your life, such as your friends, your colleagues, or even people that are the same age as you. And even with social media these days, it's going to be in your face 24/7. But it's important to remember that everybody's on their own path, and your situation might be a lot different than your friend's situation, and your goals are going to be completely different as well. And these people on social media don't even.
You can have 5 business owners that do the exact same thing in the same room, and all their goals are going to be different. Heck, most husbands and wives' goals are totally different. You're an individual and you're going to have individualistic goals, and that's natural. So don't compare yourself to other because you may be thinking you need to be doing one thing, but in reality, they're got a totally different path.
Pay attention to them. You don't even know what's going on behind the scenes. They're really just showing you the highlights of their life. The truth is that no one's going to just go up to you and show you their bank account and be like, yo, this is how much money I got. You should feel bad for yourself. No, that's not going to happen. Drawing a comparison is just going to waste your time and mental energy, and you could use that time and energy to focus on yourself. Some people love
Very
spending
true.
everything that they make. Some people love saving everything that they make. And some people are just in between. And also when it comes to spending, everyone has different values as well. It's easier said than done, but I find that if I'm not comparing myself to other people, then the amount of impulse purchases that I make as well, it goes down. Personal finance lesson number 9 today is along the same vein, and that is to avoid becoming the 30.
Before we jump into the 30K millionaire, that's important too because if you're making impulse buys like he just referenced, the key to that is those impulse buys. Like if somebody gets the latest phone that just came out, and you're like, man, I need that. Well, they may have set aside that $1,500 or slowly over the last 18 months, and it's not affecting them. Just kind of like the investments, kind of like everything else. You need to be making sure the money set is there for it. If you aren't prepared, but you want to keep up with the Joneses, you're setting yourself back every time you do that.
30K millionaire. This is a phrase that I learned about in Texas, and a 30K millionaire, according to Urban Dictionary, is individuals that make $30,000 per year but act like they make millions. So, for example, check out this 30K millionaire driving.
I know that you know at least half a dozen of these people just without even thinking. People that live like they are living in the Hamptons, but barely getting by paycheck to paycheck.
Low-end BMW who still lives at home with his parents. Or someone who goes to a club and pays to get the VIP table and then can't buy any drinks because they spent all the money on the table. What a 30K millionaire. So the lesson here is that people that look like they have money, they probably don't have money, and the wealthy people that actually do have money, they won't dress or even act like they have money at all. According to a study of millionaires, most wealthy people live well below their means. That's how they got there in the first place. The best quote of the book, The Millionaire Next Door, is that, quote, if you're your goal is to become financially secure, you'll likely attain it. But if your motive is to make money, to spend money on the good life, you're never going to make it. It's a good reminder that if we focus on our own goals and living within our means, we'll probably hit financial freedom and financial security. And that's probably what you want to do. Don't become the 30K millionaire at all. Personal finance lesson number 10 that changed my life is that what's risky for you is not risky for someone else, and vice versa. Just like
That is so true. You could drop $500 on the Super Bowl and not even bat an eye, and the person next to you could drop $30 and be the last $30 in their bank. There's so many risk assessments. Like to me, I was trading in crypto for a while during COVID, and I was having fun, but I also knew many things like stop losses and when to pull out as far as your initial investments. So you're playing with the house money. Like there's all kinds of different things. So when I implemented the strategies that I knew and was talking about dollar amounts with people and certain amounts of what I've got in each thing, if they didn't understand that my initial investment is back in my bank account and now I'm playing with house money, I feel like I'm not risking a lot because it's not even my money at this point. But to them, yeah, that's very smart.
like
True, I
not
really like
comparing
this.
yourself to others, don't make the same decisions as somebody else just because they do it. I mean, your risk profile is going to be very different than, let's say, your neighbors. You want to make sure that if you're getting financial information or financial advice from anybody, that you're doing your own critical thinking and really thinking through if it makes sense for you. General advice is not a one size fits all, and even on this channel or any other YouTube channel that you see, you should always be applying a filter to it, which is like, is this decision right for me? I don't mind if you're getting inspiration and ideas and starting points from online, TV, your friends, wherever you get that information. I think that's totally fine, but you really want to be conscious of whatever you put into place in your own life. All right, so those were my top 10 personal finance lessons. Let me know what you thought in the comments.
I hope you got a lot out of this. I hope that you understand that, um, just like he ended it with, that you need to, even when you're watching all these YouTube videos, you need to have a filter and you need to take it a step back. Hopefully, I can become that filter for you because I don't only want to sift out the negative and bring to light the things that are out there that you should be avoiding, but I want to highlight the good things. There's a lot of good information out there, but it's understanding what's good, what's bad, what you can implement, what you can't implement. Um, that sounded a lot like the same. What you can't implement and what you can implement. You have the tools to do it. Most of the time, you're lacking the confidence and just the drive just to go do it. If we become goal oriented, if you become structured, you're going to thrive. And the biggest thing with becoming structured is know path that you want to take is because you know what your end goal is. If you don't know what your goal is, if you don't know what you're working towards, then you need to pause and don't do anything. Some inaction sometimes is the best action. And that goes against a lot of people or coaching because they want you to just keep moving forward. Well, what direction are you going in? Where are you running towards? You could be going in the wrong direction and you shouldn't be running anywhere until you know where you're going, right? So I really like what he has to say. I think you can do all those things. I there's nothing too complex that you can't do today. And a lot of times, and I'm sure, throw in the comments, what are you going to implement? I think instantly of stocks and investing, and people are like, man, I don't know enough. Well, start thinking about trends. A good friend of mine invests in Campbell's soup every winter because he says, you know what, no matter what, when the weather gets cold, people are going to get sick and they're going to buy soup and their sales are going to go up for that quarter. And then at the end of the quarter, I'm going to sell the stock because it's going to drop down during the nice times of the year. And traditionally, if you pull up the chart, you're going to see that it does have a spike there. So find those trends, understand how things work, and put your money there, and you're going to be fine. Or at the worst case, find something that historically has done well. Put your money even in like the S&P, something that is going to be the top 500 stocks, and let it sit for 20 years. He just said, math wise, you're safe. Hey, have a great one. I look forward to bringing another video to you soon.